there is red across the Asian screen.
Cut the 7-day reverse repo rate.
7.44 against a poll of about 6.6% was a shocker.
The falling trend line, which comes in at 19,570. And that's the one which needs to be crossed.
Infosys has won a mega deal. It's worth 1.5 billion euros.
IP's MD Anindya Datta has packed his bag.
Nifty is down about 82 points, so not a good opening at all.
Markets just reacted to all the good news that's there in the corporate world, right?
Core inflation number was actually better, and I think that's what we need to focus on.
A market regulator came back with a confirmatory order reiterating its stand against the promoters.
Compared to our neighborhood, this is not a bad picture at all, though it's a red screen.
Interglobe Aviation, this is the third tranche of stake that the Gangwal family has sold.
A strong listing for the SBFC Finance.
OJA, in a manner of speaking, is a key element of our strategy to go global.
It's been a swift recovery from the lows, but the Nifty still is in the red.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel D'Souza. Joining me, Prashant Nair as well as Surbhi Upadhyay. Well, good afternoon, guys. Buy on dips worked today?
Not a bad day compared to how we started.
You know, it's an exact repeat of Monday, actually, right? I mean, the intraday will come up on your screen and it'll tell you what I'm talking about. Almost ditto repeat of Monday, 100-point cut early on in the session, and then bulk of the day spent recovering. You know, it's just quite incredible. And by the way, the cut was not as steep as what we had on Monday in the first 30-40 minutes of trade. It was shallower than that. And, you know, it's almost an exact repeat. So the 40-day exponential moving average is at 19,360. And that was the level which the market defended on Monday. At the close, we closed above 19,400. And we are above 19,400 once again. So the market doesn't want to go down. Nifty bank recovery, again, like Monday, is a little weaker as compared to the Nifty. That index is still down a third of a percent, although off the lows by quite a bit. And the strongest part of the market, forget this market, anywhere, right? I mean, the Indian small caps have been the strongest asset class, I think, since March or maybe even this year. You can compare that to anything else in the world. That index is up another 0.5% or so in trade. So it's a pretty good-looking screen, given circumstances that we started with in the morning. Surbhi.
Hi, Prashant. Yes, absolutely. Green on the screen, not looking bad. And that's thanks to some recovery in global markets, though, of course, Asia was quite negative. If you're looking at the European screens, there's some green out there. So that's some respite. By the way, inflation in the UK is now looking better than the print here in India. We were talking about, for the longest time, we used to talk about headlines in the UK and really, you know, difficult inflation. That number's come down very sharply to 6.8%. We're at 7.44%, the latest print. So just that's how, you know, things have moved. But anyway, just to talk about the recovery and where the bulk of it has come in from, the bank Nifty is still down, and banks have been the sore spot, not just today, but for many, many days we've been saying that. But even the bank Nifty has recovered. In fact, it was at the lows, the bank Nifty was closer to the 43,600 kind of handle, almost testing the 100 DMA, but it's been a very sharp recovery for that index. Aside of that, if I talk about the green side of the screen, IT was anyway, you know, the one pillar of strength, and that trend is continuing. Infosys, for instance, is up about 1.5%. But even the other names, and you have L&T right now, SBI, HUL, and a couple of these auto stocks, by the way, Mahindra and Mahindra Maruti, autos are looking pretty good, at least at this point in time, in the last 1 hour. Nigel?
Well, you know, Surbhi, the buy on dips worked today yet again. The Nifty and the Nifty Bank, what a good recovery we have seen from the day's low, right? You know, the Nifty Bank flirting with the lower levels. The Nifty as well went to lower levels. But the bulls, for the final 60 minutes, they'll want a very, very good close. That's what will keep them in check. Because if you're looking at the options data, the Nifty is at around 19,440. All right. Now, if you pull up the 19,400 call, actually we have 40 points in the money. So let's pull up the 19,400 call option actually. The premium out there is still lower because there is a writing that we're seeing at those levels. So this particular strike, we have 40 points in the money, and yet in fact you're seeing erosion on the premium. This expiry in fact plays out tomorrow. So, you know, the positioning as of now is 19,470, 19,480 approximately. That level gets defended. Just want to show you the kind of aggression we are seeing on the writing side. Now, either these call writers go right or they go wrong. So at least in the near term, at least for today, you'll want the Nifty to end around these levels or maybe a little bit higher. A strong close is what you're looking forward to. On the downside, massive openers built up at around 19,400 put. The premium out there on an average was around 50 rupees odd. So 19,350 becomes a very, very crucial mark today. We need to see a good close. The bulls will feel far more confident given that this market is net short. The big question is, how do you position yourself for the final 60 minutes of trade? Mitesh Thakkar joins us to tell us exactly that. Hi Mitesh, good afternoon. What's your reading of today's move? Buy on dips? Well, it's worked for the second day running. But do you think the Nifty has enough to say get towards the 20 DMA?
Good afternoon, Nigel. The buy on dips trade has worked well, but I think, we were not very keen to buy early in the morning. See, this is still a market which is now trying to find feet. And the good thing is that on all the occasions, while they're having intraday venturing below 19,300 levels, the gap around 19,200 levels has not been tested, nor there has been any serious attempt for the gap to be filled up. So I've maintained the stance that 19,200 is a good pivot to look at, and that should be the key support area. And on the upside, 19,620 to about 650 is the supply pivot. So I think we'll be chopping around, we'll be consolidating in this range. The market is now showing a lot of signs of contraction with the volatility indicators turning flat. And therefore, a range seems to be very high probability outcome. So in that sense, I think, we'll be trading with more of range strategies. Try to buy near the lower end, 19,250, 270 becomes your buying zone. 19,600 plus levels become your selling zone. So that's the way Nifty should be approached at. On the stock side, I have a buy on Colgate-Palmolive. After a few days of consolidation, the stock is really picking up good strength and doing good traction. So recommend buying here. Keep a stop just below levels of 1970. Look for targets around 2050, which was the recent high, to be tested, maybe, crossed on the upside. So there could be further extension on the upside as well. That's one. And the other one which I would recommend on the selling side will be Crompton. Very negative price and volume action today. Sell here with a stop at about levels of 288 for targets of 270.
Okay, all right, got that. Mitesh, thanks very much for the calls. We'll come back to you in about half an hour. Let's take the conversation forward and talk about a couple of interesting stocks that are bouncing around. By the way, also should mention that today's listing has done really well. SBFC Finance is clocking gains of over 60% now. So we'll talk more about that with our guests as well. But that's, quite a sharp shooter as we're talking about the primary market action. So good going for this one. Let's now put the spotlight on Indigo. That stock has been under pressure after the block deals that we saw today. Sonia is joining in. Of course, the market intelligence is that this is probably Mr. Gangwal selling a part of his stake. Of course, we'll have confirmation only at the end of the business day. But Sonia, do share the details with us.
Oh, absolutely. And it seems like it's a season of promoters selling stake, right? But as you rightly pointed out, we don't have official confirmation just yet. Just to give you the trade that took place, there was a large trade that took place this morning where 2 crore shares, which is 5.1% equity, changed hands at a price of 2,430 rupees. And this was worth almost 5,000 crores, so a fairly large deal taking place. There was a very strong response coming in from global as well as domestic funds. So it is likely that the Gangwal family has sold part of their stake, and that has been received by a lot of global as well as domestic funds. Now, the Gangwal family, this is the third tranche of selling. And, after the selling that they've seen earlier, they had about 29.7% stake. And post-selling of this stake, they would be somewhere to the tune of around 25.7%, which is still almost 25,250 crores worth of stake that the Gangwal family has. So there is a bit of an overhang that perhaps, there could be more promoter stake selling. And that could be the reason why the stock is under pressure. But the larger story here is the zooming business of Indigo. Indigo has about 80% market share in some of the monopolistic routes. It is the market leader in the space right now. The stock has surged almost 40% in the last 6 months. The earnings have been very, very strong. In fact, in the quarter gone by, it's been record high EBITDA and revenue for the company. And there are still many tailwinds, whether it's strong domestic traffic, whether it's, higher yields, lower crude prices. And there are many bulls on the street as well. So Citi, for example, raised their target price to 3,400 rupees, which is a big upside to the current market price, while Macquarie has outperformed with a target price of 2,950. Back to you.
Okay, got that. Thanks, Sonia, very much for the details there. So Interglobe Aviation in the news today. Prashant, we have Prakash Diwan joining us on the show this afternoon. Prakash, good to have you on as always. Let's start with that. I mean, Interglobe has, of course, had a dream run going all the way to 2,700, and then, the stock's been cooling off last couple of weeks. What do you make of things? I mean, the business dynamics, we know what's happening at the airports, but beyond that, how should one look at Interglobe, and would you at all look at buying the dip?
Good afternoon, Survi. So, interestingly, a few months back when Tata consolidated their holding in Air India, and there was this whole threat that Vistara and Air India put together would be such a formidable competition, and Indigo probably was available, and that was the last round of sorts where you had it available at softer valuations. But the quarter that's gone by and the continuation of Go Air's inability to come back into the inventory, which is almost like 9% of the domestic market inventory, has allowed them to get into slots which are very profitable. So they're probably the only or the second airline in some of these new slots that they have acquired. And, I also hear about murmurs about them ordering Boeing aircrafts as the next round, making a deviation from the Airbus fleet that they've run on. So, this is very clearly a company that's setting its sights on much higher scale, much higher, inventory, much higher margins. But, the quarter that we are currently sitting in is going to be one of the toughest for them, because prices on crude have gone up. And the demand, while it's overall very nice and good, but the ability to pass on prices beyond a certain limit also gets inhibiting. So, if they are able to manage this lull or this kind of weak quarters, then you'll probably have a reset. But my sense is once the June end numbers come through, the September end numbers come through, you'll probably see a little bit of consolidation and some sort of a time correction in the stock. But the story is intact, whether I see it as an analyst, whether I see it as a consumer. You don't have they don't have much to complain about from Indigo in terms of how they run their operations so efficiently. But you have a lot of debt on the books, and that gets kind of vulnerable of sorts. The balance sheet is quite vulnerable at this point in time. And I'm not very worried about this event on one of the promoter families moving out. This was almost like preordained of sorts. It's just a matter of timing. They did it about 10 months back. So there's nothing very spectacular about that trigger. But I think it's going to be earnings that's finally going to come center stage, because they've set a very high benchmark. So let's wait for that. But till then, if you get it on dips, it's definitely something you could add to your portfolio and look for the 3,000 mark in the next 6-12 months.
Okay. All right. Thanks a lot for that, Prakash. Just hold on. By the way, a few stocks in the broader markets are really spiking up. JSW Energy, we had a large trade. GQG, they bought, more than 1 crore shares on Monday's trading session. This morning as well, there was a large trade that took place. That stock is flying away, up at the high point of the day. HCC as well is doing quite well. Some of these stocks moving higher. And VIP, well, that's, perked up in trade despite the negative news. In fact, we had the MD's resignation that came on, but the stock has recovered big time. Mangalam joins us to tell us about this unusual mover. Mangalam.
Well, that's correct. Nigel, the MD's resignation came in yesterday. The MD who had taken over just a little over 2 years ago, that's Anindya Datta, he came in from Havnor, and he's gone ahead and tendered his resignation, citing personal reasons. On his part, the important part is that the company has gone ahead and found a replacement as well. Neetu Kashiramka, who was the CFO of the company, was elevated to the board just a couple of months ago, has now been made the MD designate. She will take over from December itself as the MD. Importantly, Anindya's predecessor, also Sudeep Ghosh, tendered his resignation after being there for 3 years at the top and being in the company for about 8 odd years. So for a family-owned, promoter-owned company, so much churn in the top management is something that the street usually does not like, and as a result of which the stock has been an underperformer over the last 1 year as well, if you compare it with the likes of Safari or the big surge that we've seen in the post-COVID travel-related stocks as well. However, underperformance in the stock, usually clubbed with a management resignation, means that the stock bottoms out on that day as well. Is there a plan in place for the company going forward or not is the big question, and as a result of which, that's the bet that the street is taking. From today's lows, we've seen a big recovery on the stock price.
Right, Mangalam, thanks a lot for that. Now, just to give you guys a couple of numbers, Mr. Sudhir Jatia, who took over Safari, in 2012 on, he took over the company for around 60 crores approximately. They were doing sales of, I think, roughly on 60-70 crores odd. At that point of time, 10 years ago, Safari sales were a tenth of VIP. So they were really small in comparison. VIP was doing 800 crores odd. If you look at the last quarter, Safari sales are at 60-65% of what Safari of what VIP is doing.
That's
so
a
the
massive
big
surge,
market share move that we've seen out there, and explains why Safari has been a big outperformer. In terms of market capitalization, they're almost equal as well. That 8,000 crores, 7 to 8,000 crores odd. So that gap has got bridged out there. Prakash, what's your view? VIP has been an underperformer, but maybe the street is looking through these, these resignations. How would you approach the stock?
So, Nigel, I think, you explained it so well. I mean, you have a challenger in the form of Safari, which came in from nowhere, was a turnaround, and it was so beautifully executed, whereas VIP probably took its leadership for granted, and it's just been losing market share. And you remember, it's a very competitive industry. Any areas that you slip on, be it marketing, distribution, brand building, you actually kind of, the market doesn't like any of those metrics weakening. And at 9,800 crores market cap, it is quite richly valued. I mean, on a trailing basis, must be 65, 67 times, which is significantly higher in terms of this. So your margin of error is extremely low. I mean, you really can't mess around with that. And, this whole thing of the change in leadership takes away the entire win from the sales of the company in terms of building a marketing plan and get back into its market share. So it's going to be difficult for them to seize that. And while all of this is happening, I would be surprised if Safari actually takes off even in certain pockets where they are slightly weak, especially the backpack market or, the soft top luggage. So there's enough room for them to innovate and get it. And VIP would probably pay the price for some more time. I would definitely pass at this point in time, not look at it.
Okay, got that. Prakash, one area which where no one wants to get out of or sell anything is capital goods. It's absolutely people are holding on, saying, well, this is the space which will continue to make money. But if you had to just get exposure, I mean, think of someone who doesn't own any capital goods names, and you'd recommend fresh allocation. What would the top 2 or 3 ideas be? It doesn't matter, large cap, mid cap, small cap, but which are, in your overall kind of perspective, what would rate best as top 3 ideas there in that space?
So that's quite a complex issue to grapple with, and I know a lot of investors are seeking answers for this, Prashant. So I'm glad you took this up. The reason is we've seen cap goods come up from probably the last 12 to 15 months, if not earlier, where very distinctly there's a trend which has helped make all boats rise. Now, what's happened is the MNCs were in the forefront. You had the likes of Cummins and ABB and Siemens and all of them, which actually took off much earlier. And then the domestic pure play started working. If you were to look at anything right now, and cap goods can get subdivided into a lot of things. It could be mining machinery, equipment. It could be industrials on the assembly line side. So it could be defense also. There's so many cap goods which are related to that. But there are some businesses which have morphed themselves into a very strong business, which, from verticals where they traditionally are present to verticals which are newer to them. And that is, I think, going to be a big story. For example, Thermax. I don't think Thermax is doing stuff that they used to do 10 years back on boilers and things like that. They've moved so much into the value chain on the green energy side that it's transformative. In fact, there's very little known about their business because it's yet to kind of complete a few cycles. Now, those kind of businesses are what you could still buy because the long-term trend is fairly secular. And I keep on saying one of the biggest areas of growth in India, which we're seeing with NMDC, today you had the management talking about such ambitious numbers. You have Coal India reporting such good numbers. Anybody who's in the mining equipment side will probably benefit. So there are some small companies there, whether it's material handling, drilling equipment, lots of them. So you look at the Kirloskar group of companies, some of them have done exceedingly well, and they have some very strong numbers that they've projected, including Kirloskar oil engines also. There's just so much to choose from. So I don't think people need to get that FOMO. You'd probably have a smaller cluster which is still offering value, but there is value. And then if you sit with your advisor and decide to allocate some money, I'm sure you'll be able to find some. But, the more popular names are the ones which are getting too richly valued. So I would kind of refrain from naming those or getting into those. But I don't see any reason why, as a sector, it could still continue to offer great opportunities for people who have yet to kind of allocate money.
So two Thermax and Kirloskar oil engines. Two names, right? You want to add a third to it, Prakash?
These are very top of the mind kind of recall where you could still seek and find value. Yeah.
By the way, Kirloskar Oil Engines, I mean, the management is joining us tomorrow morning on the program, so you might want to sort of listen in. And I think out of the, I mean, I think between Kirloskar Oil and Kirloskar Brothers, Kirloskar Brothers, of course, has done phenomenally well, but this is the more reasonably valued one, Kirloskar Oil Engines. So that's going to be an interesting one. Prakash, stay with us. We'll take a very quick commercial break. We'll come back. Shibani Sarkar, Korean of Kotak Mahindra Asset Management Company, will be joining in on the other side.
Well, Manglam, we've come to the season finale for Mad About Markets. What do we talk about?
Season finale. Let's end on a high celebratory note.
Well, that gives a cue. Do we really still have to tell them what we'll talk about?
Do we?
Welcome back. You're with us on Closing Bell, and we're tracking this recovery that's intact, at least for now. So you're seeing some of those flashes on the screen. The cabinet is likely to have approved a big bus order. It could be worth as much as 63,000 crore rupees, spreading across 170 cities. We'll try and get Sonia in on that in just a bit. That's coming in from our sister channel, Awaz. But right now, let's actually put the spotlight on another stock, Glenmark Pharmaceuticals. They reported a decent set of first quarter numbers. Revenue growth was better than expectations. Margins were in line. Earlier, Prashant, Sonia and Nigel were in conversation with the management, spoke with the VS Money Executive Director and Global Chief Financial Officer of the company. Take a look. He sounded quite optimistic, actually, about the overall growth targets. Take a look and we'll come back and discuss the company.
In terms of our guidance, we had guided the street to about a 10 to 11% growth in revenues, as well as about a 19 to 20% EBITDA margin. So we would currently like to hold on to these guidances. Improvement in the overall quality of business, as well as improvement in the margins, and also keeping our capexes in good, managing it well in terms of 600 to 700 crores, as well as keeping our R&D expenditure between 8 to 8.5%. I think we are hoping to have some decent cash generation as we go along to bring down the debt as well. So we had given a guidance that during our last investor conference that by 26 we should be net debt positive, negative. So I think our overall revenues, we are seeing about 100 million in terms of the US, $1 million per quarter. So I think that's good traction, and we see a single digit growth in the US.
Okay, that was the management. Prakash, any interest in Glenmark? Of course, there's a lot of talk about some stake sale perhaps happening in Glenmark Life, and he also clarified on that. But would you look at either of these stocks, considering that pharma has done pretty well and it is pretty much the flavor of the season in the market as well?
So, not taking away from Glenmark's excellent, turnaround of sorts in the last 2 years, and one of the reasons why the stock has done well, on the back of those improved operations is because it was very under-owned, and you've seen that interest come back. But the stake sale on GLS is something which has been talked about a lot, but till it happens, you can't really factor that in terms of what optionality would you want to accord to the parent stock. But from this space, there are some names which have either to been ignored, and you'll see a comeback more on those names. I kept on talking about Syngene right from the 530, 550 zones. We've seen that move into that 800 kind of neighborhood. You probably have a similar play in Marksons now, where things have improved so well. We've seen last 2 or 3 quarters very consistently show incremental improvement. So these are names that you would probably watch out, because they're yet to be they're still under-owned largely. And the institutional interest would probably make a lot of difference, once it starts happening. None of these companies have too much of ownership yet, because by and large, institutional ownership within the pharma names remain restricted to the top 5-10 names. So some of these mid-cap pharma probably have started getting their act together and will start rewarding much more disproportionate. So that's where you probably make some money for the next couple of years. Glenmark would continue to do well. The numbers which they've guided for are very impressive. So even if they stick to that and adhere to implementing that, it will give you that organic 10-15% of a bump up. But there could be better alpha generating opportunities in the neighborhood. Yeah.
Okay, all right. Prakash, just hold that thought. By the way, some mid-cap IT stocks have come in for a hard knock. Let's pull up some intraday charts. We have Coforge. I think that should come up for you on the screen. Emphasis as well. A couple of these names, suddenly they're seeing a sharp downtick. In fact, Coforge in particular, suddenly that stock has moved to the low point of the day, down close to around 4.5%. Emphasis is slipping a little bit. Intellect Design Arena as well. That one's seeing a little bit of a downtick. So I don't know what's got these stocks nervous, but clearly something seems to be worrying them. They've come up substantially in the last few minutes. Prakash, what's your view on mid-cap IT? Some of these names actually have been quite resilient, but they're slipping a bit. Would you look at some of these stocks as a buying opportunity?
So, Nigel, I think by and large, IT is kind of making a comeback, but it's, different pockets. You've seen some of these large wins that HCL and Infosys reported. So, very clearly tells you that wherever the underlying sector is not BFSI, it's largely engineering or telecom, probably see a turnaround happen sooner than later. And that's where the clients, the orders have originated from. So some of these mid-cap names where, that resilience could probably be dependent on the underlying sectors that they cater to for their core revenue. So, for example, Cyient has a very clear franchise. You have Sonata, which is such a strong platform franchise. So those are the names that you would have to stick to. But remember, the rotation within mid-cap and large-cap IT will also be very swift. So if market starts sensing that the large-cap IT is likely to turn around, we'll probably see some profit booking in the mid-cap ITs, which have done fairly well, even in that tough phase, because they probably were not as vulnerable. They were far nimble than the large ones. But the likes of TCS and Tech Mahindra could make a very quick comeback on the markets, on the stocks. And that's where probably some rotation could happen.
Okay. Prakash, we'll leave it there. Thank you very much for joining us. As always, it's a pleasure having you with us here on CNBC-TV18. CNBC Awaaz reported that the government is likely to allot 63,000 crore rupees for electric bus procurement. This is expected to benefit lots of listed names, unlisted as well, I'm sure. But let's just get the news out. Sonia is here with details. Sonia.
So, electrification of government vehicles has been a pet project for this government, and they are moving really fast on this, especially with the state transport undertakings. Now, our sister channel CNBC Awaaz put out an exclusive saying that the cabinet is likely to approve a whopping 63,000 crores for electric vehicles. This will largely be for EV buses and across cities in India. The EV bus services will be started in 170 cities under this scheme, and it will be run via a PPP model, or the public-private partnership model. Now, the central government will allot about 20,000 crores towards the scheme for EV buses. Now, if you look at a lot of these listed stocks, right, this theme has played out for the last 1 year. So whether it's JBM Auto, Electra Greentech, Tata Motors, Ashok Leyland, all are big suppliers in the EV space. Something like Electra Greentech, for example, is up 144% this year already. So this story has played out. Of course, now the bus, if you look at the way the orders are given out, they are very lumpy. So Electra Greentech, for example, in the quarter gone by, the EV bus division had was under a lot of pressure because they could not, see a lot of revenues in this particular quarter. So it is a lumpy business, but overall, these are the big beneficiaries, and hence you're seeing, some gains on these stocks today as well. Back to you.
All right, Sonia, thanks very much for that. So that's the story coming out of Delhi, and we'll have more on this in greater detail as we go along. Shivani Sarkar-Kurian is with us, Senior Executive Vice President and Head of Equity Research at Kotak Mahindra Asset Management Company. Shivani, good to have you with us here. Thank you very much. I'm going to stump you with this latest news and ask you to react to it, but I want to just stick with what is broadly the flavor of the season, if I can use that terminology, which is capital goods. The build out of infra and who will benefit. It's not a new one, but it seems to be the most, at least in the minds of investors, the most durable one. The one with the longest runway. At Kotak, Shivani, if you can just kind of, I know you can't name names, but if you can identify areas within the capital goods segment which stand to benefit the most, where there are still opportunities to be found.
Yeah, hi, good afternoon, Prashant. Pleasure to be here. So yes, capital goods, industrials, manufacturing, infrastructure as a theme has been something that we at Kotak have been positive on for a while now. This is a theme that we believe is a structural theme. Couple of things here. One, what we have already seen is that the pickup in public capex is there for us to see. Incrementally, if you look at capacity utilization levels at a headline number, the number seems to be now moving above long-term average trends. And therefore, we do believe that we are on the cusp of some improvement on the private sector capex as well. Now, if you look at what's been happening maybe over the last few quarters or so, the numbers that have been coming out from a company perspective, order inflows have been by and large fairly robust. And therefore, that is leading to this confidence that this theme is a more structural theme going forward. Government spending on infrastructure is clearly driving demand at this point in time. But as we were discussing, private sector capex should also start to incrementally pick up. In terms of investments that are happening in some sectors which are more upcoming in nature, whether it be renewables, energy storage, hydrogen, etc., that incremental investment is also likely to be driven by the private sector, which should also aid the overall growth that we are seeing in this particular segment. What we are also, however, cognizant of at this point in time is that the sector has done well. Therefore, in pockets, valuations have seen a run-up. So while we continue to believe that the growth opportunity in this segment remains fairly strong, we are also cognizant of valuations. And therefore, from that perspective, we would look at incrementally stocks where there is some amount of valuation comfort. But what we are really seeing in terms of the entire manufacturing infra play, that theme continues to remain fairly intact, and we have been overweight across these sectors, and we continue to do the same.
Shivani, hi, good afternoon. Yesterday I was hosting a show with Mr. R. Dinesh, the president of CII, and obviously the head of TVS supply chain as well, and he said exactly that. And they get anecdotes from all industry members, right? And he said that private sector capex, watch for the space. Next 2 quarters, you'll start seeing announcements because we are at 75%, 80% capacity utilization, which is typically that threshold, that inflection point. when companies want to put up more capacity. So get your point. I think it's, it's all pointing towards that direction. But let me ask you a follow-up on exactly that, the valuation part. Considering that stocks have been pricing in a lot of this excitement, what parts of this, sphere are you looking at? Give us some more clues. Again, not stock names, but where you do find that valuation comfort that you spoke of.
So yes, you're right. It's tough given the fact that the sector itself has outperformed and there has been a run-up. But what we are really seeing is in segments such as where there's faster growth, so whether it be industrial consumables, in the core capital goods space, segments where you're seeing new investments happening in some of the areas that we spoke about, either renewables or any of the new segments of capex. So those are some of the segments that we are looking at overall. Also, we are looking at players who benefit from the pickup that is possible in terms of the private sector capex as well. So it's a wide spectrum of stocks, but of course, very difficult to point out in terms of the stock names, etc. But overall, the spectrum remains fairly wide. So whether it be manufacturing as a theme where you are benefiting because of the entire policy push, whether it be defense as a segment where again we have seen that the order flow growth continues to remain strong. And another point that I might just add, which I possibly missed out last time, is that overall in the sector, while growth and revenue growth has been strong, order book has been strong, incrementally also starting to see margins improve. So that is also aiding earnings in this particular space. So by and large, from this entire theme, we believe that the theme is a structural theme. Valuations in pockets may limit some immediate upside, but it's pretty much structural in nature.
Right, hi Shivani, just hold on to that thought. We have a couple of large trades that have taken place actually. Adani Power, there's a large equity that changed hands, so they're more than 5% equity. So let's just get that stock by the end of today. I'll be interested to see who exactly are the parties on this one as well, because Adani Power, large trade is just took place, and that's why we're seeing a knee-jerk reaction on that particular name. And also just keep an eye out on the market. Well, we've moved to the high point of the day. It's a massive recovery that we've seen from the day's low. And a few stocks that are doing well. Mahindra & Mahindra has moved to the high point of the day. I think HUL as well has moved up in the last few minutes. Power Grid as well. So a couple of these stocks, they're doing well. And that's what's helping the Nifty recover. Well, Shibani, sorry I had to take that market check since a couple of big moves were taking place out there. How are you positioned, Shibani, on the pharma space? That's been a space that's been boring, not given returns. But there are signs now. Price erosion is lower in the United States. There is, the worst of the API shortage as well as behind. And maybe if you compare valuations with the 5-year average, it may not look so expensive. Your positioning out there, do you think it's time for pharma to fire?
So, Nigel, in our portfolios, we've always approached pharma more stock-specific in nature. That approach continues. However, while you rightly pointed out that this is a sector that has really not done much in the last many years, valuations are not expensive, but then valuations are not very, very cheap. So overall, if you look at long-term averages, valuations are close to long-term averages or slightly below long-term averages. However, there are pockets of opportunity. One is in the specialty pharma space, you continue to see growth, and therefore that is one segment which one can look at. Secondly, as you rightly pointed out, in pockets, the kind of price erosion that we had to contend with over the last few years has started to moderate. Most of the management commentary seems to suggest that price erosion is now stabilizing in somewhere in the mid-single digit kind of a range. And the margin pressures have also started to abate with input cost pressures coming off. Within the pharma space, if you look at the overall positioning, what we believe is that structurally the domestic formulations business continues to show fairly healthy growth, which is a high single digit to low double digit kind of growth. And again, there also we are starting to see margin pressures come off. By and large, selectively some of the specialty pharma plays as well as those which have presence in the US business where there is a larger approval pipeline in play. Those are some of the stocks that we would also possibly consider. And finally, the third aspect of pharma is healthcare and hospitals. This is a segment we have been positive on, but however, we are also cognizant of the fact that in the hospital space, valuations have run up quite a bit because of the outperformance. And therefore, we are mindful of valuations, but overall healthcare and hospitals continue to remain fairly well placed. given the fact that you are continuously seeing occupancy levels remain stable as well as revenue growth pick up.
Okay. No, so in pharma, it's domestic pharma or US generics, which because some do believe that there's a strong tailwind for US companies operating there in the generics market. Do you believe that, or you think it's still more domestic?
So domestic is more structural. I think tactically there is an opportunity where US generics players are concerned. That's exactly what we were discussing, that the price erosion and the pace of price erosion has moderated, and therefore in the near term you could start seeing better growth where US generics players are concerned. But again, one would also have to, in pharma, as you know, that even within the US businesses, look at those companies which have a better approval pipeline and therefore more runway for growth. Structurally, the domestic business continues to be somewhere where we believe that the runway for growth remains more structural in nature.
Shivani, finally, leave us with your thoughts on banking and this underperformance that we've been seeing. I've been trying to sort of ask a lot of people on the street about this. One theory is that apart from the NIM compression that we've all noticed in the first quarter, one more theory I heard is that the kind of FII selling that we've had, that's taking a bit of a toll. Just your thoughts, and whether, at a more fundamental level, whether you're at all more cautious on banks, specifically on that margin compression point.
So, Survi, I think a couple of things have been at play. One, of course, as you rightly mentioned, margins seem to have peaked out in the fourth quarter, and incrementally you are seeing some amount of that margin compression come through. The second also could be over ownership and the levels of ownership, both domestic as well as FII, especially where some of the private banks are concerned, which could also be an impact in terms of the way the segment is moving. However, when we just take a step back and look at what's happening fundamentally, now, we've seen that over the last couple of years, banks have seen sharp improvement in terms of their return ratio profile. Banks have seen, obviously, credit costs are extremely benign. And more importantly, capital ratios are fairly above regulatory averages. So you've seen an entire space where you've seen expansion in ROA, you've seen expansion in ROEs, but valuations are at long-term averages. So the multiple re-rating per se has not taken place where banks are concerned. So that gives you some comfort where the entire banking financials pack goes. But having said that, in the near term, over the next couple of quarters, we will possibly have to contend with some amount of that margin erosion. However, that margin erosion can be offset with some amount of that operating leverage play out with OPEX, especially in case of those banks which have upfronted some of their OPEX. And most importantly, credit growth in the system has not fallen off the cliff, unlike what was earlier expected. So credit growth is holding up fairly well. So by and large, we continue to be fairly positive on the financial space. Near term, we will have to contend with some amount of that margin compression. However, if the rate cut cycle gets pushed out to sometime next year, the sharp margin contraction that was expected, because if there is a repo rate cut and lending yields reprice downwards, then that gets pushed out as well for banks.
Okay, all right. We have to watch out for that. It is exactly those expectations that I think are pushing up bond yields as well. Thank you very much, Shivani, for joining in. Good chatting with you as always. We will take a quick break on that note with the news that the market's actually cruising along quite well. Nifty at 19,471, 36-point gain. We're practically at the day's high. Quick break. We'll come back and, as always, get you a check on all the chatter from the dealing rooms today and also some trading ideas for the last hour.
Welcome back. Well, stocks are moving around, from the broader markets as well as the headline index. For the time being, we're holding at around 19,470 odd. Good time to get you some technical trades, what to buy or sell for a reverse trade in the coming days. Mitesh Thakkar is back with us. Hi, Mitesh. What do you have for us?
Well, I think, what I would recommend possibly is a BTST and Lupin. I think that's showing good strength. It's moved up to the day's high. Could see continuation tomorrow. So keep a stop just below levels of 1100. Look for 1130 as the near-term target. And ICICI Prudential, I think, that's on the negative side. It's trending slightly on the downside. So STVT with a stop at 551 for targets of 537.
Okay, all right, got that, Mitesh. Thank you very much for the trades right now. Well, it is time to get to our special segment, D Street Chatter. Nimesh is, I think he's with us right now. Nimesh, actually, before we get to the chatter, I think the biggest buzz right now is this 8% block that's just happened, 8.1% on Adani. I know it's very early right now, but anything that you can share with us, anything you've picked up?
Well, should be, according to my sources, what I understand, it's basically the promoter entity which have sold stake in the block deal today. So the promoter holding is close to 74%. So they were the large sellers in today's block deal. And in terms of a buyer, I understand it's a single buyer who's bought this entire 8%. A marquee name will come in the block deal data today. So that particular fund across all his schemes has bought this 8%. So a big block. And I just need to calculate the amount as well, because 8%, I think the Adani Power current market cap is close to 8 lakh crores. So close to $1 billion is what Adani Power, the promoters have raised by selling this 8% in the Adani Power block deal today. So I guess we'll flash it as well. I think market will be able to predict the name as well, but not to speculate. But I understand there is a single buyer across the schemes. They've bought this entire 8% from the promoter entity in Adani Power.
Yeah, it's $1 billion, Nimesh, because the market cap is 1.08 odd. So correct. Bang on that one. But Nimesh, tell us, what else are you picking up in terms of how are the flows? We've seen a good recovery. Buy on dips has worked yet again.
Yes, Nigel. For the second day running, this buy on dips has worked. But unlike yesterday or on Monday when the FI flows were not that strong, today I believe there is a small market at close buying as well. I think that's helping the market to recover from the intraday low. So that's the overall feedback. Again, in terms of flows, a mixed day of trade, but I guess there is some selective buying now back in the technology stocks. Some bit of buying is back in the large cap names as well. So that's clearly playing out as far as Nifty is concerned. I guess from a technical range point of view, the 19,400 to 19,800 seems to be a tight range, and if you've been negotiating for the last many weeks now. But broadly, I guess this buy and dips is working for second day running, and there is a small market at close buying as well at a leading FI desk.
All right, Nimesh, also tell us individual stocks. You've already given a bit of a scoop on Adani Power, and you have got a few more stocks as well. But before we get to your list, Nimesh, just around 20 minutes or so ago, Coforge, suddenly there was a large downtick. Have you picked up anything on that? Do you want to clear it out for our viewers?
Well, Nigel, again in Coforge, the strong buzz in the market is that maybe a large block is going to come in Coforge very soon. But I was just looking at the shareholding pattern. Yes, we know that Bearings has been a big seller in Coforge in the last 2 years. In fact, their holding has gone down all the way from 60% to now 26%. So now that the Bearing holding has come to 26%, the feedback from some fund managers is that unlikely that there could be a large block, at least from a Bearings point of view. So that's the overall feedback. So while there is an anticipation, there is a strong buzz of a large block, it looks unlikely. That's the overall feedback that I'm picking up from some buy-side analysts, that given that the Bearing stake is now fallen to 26%, they may not like to go below 25%. So that's the rationale given to me, that maybe that's the reason why a large block may not come in Coforge very soon.
Okay, but yes, quite a decline in the last half an hour on that stock as well. Thank you very much, Nimesh, for all the details. Just tell us before you go, beyond these names, we've discussed Adani, we've discussed Coforge, anything else, anything interesting in the market stocks that you have your eye on today?
Well, there'll be a lot of stocks and a lot of names buzzing around. So I'll start with the two block deals which happened in the pre-open today in today's market. So first one was IIFL Securities, a big block there as well. I understand some large HNI investors were buyer in today's block deal. So the disclosures will be quite interesting as far as IIFL Securities is concerned. And the second one was JSW Energy. Again, there was a large block. But in today's block, I understand the promoter entity was a seller, and GQG bought on Monday in a block deal was a buyer in today's block as well. So maybe after today's block deal, GQG is holding in JSW Energy. is going to be close to around 2.5 to 3%. So again, in JSW Energy, the disclosures could be quite interesting in post markets today. So that's a couple of pre-open deals. The second stock is Manappuram Finance. Again, it's a very strong stock of late. Post numbers that's really outperformed Muthoot as well. But again, in Manappuram Finance, there is a clear indication now that a large block is going to come very soon. I've been highlighting this for the last 2 weeks now, that there is a large block from a private equity investor which can come in Manappuram Finance. So maybe that's pretty much on the works and can happen very soon. So that's something to track in Manappuram Finance. The third stock is HP Adhesives. Again, not been buzzing too much of late, been consolidating as well. I believe there could be a large corporate development in HP Adhesives very soon. On Monday, there was an interesting block where a Hong Kong-based hedge fund bought a large chunk in a block deal. So maybe this is something to keep on radar. That is HP Adhesives. And the last stock is Ashok Leyland. Within the auto names, this is one stock which is standing out in terms of huge volumes, largely on back of very strong buy flow. So that's on Ashok Leyland as well.
Okay, all right. Nimesh, thanks a lot for that. Yash is waiting by to give us some updates, but just want to pull up the intraday chart of Johnson Control Hitachi Air Condition. I think we should get the intraday chart out there, Surbi. The stock was up as is, I think, 10% earlier. But as we speak, that's got locked in upper circuit, up close to around 20%. We're eyeing the Nifty. It's in a consolidation phase, moving a few points here and there. Stocks are off to the races, up 18-20% in a single session.
Yeah, it's a good spot indeed. What a mover, really. We've got our eye on the screen, but for the time being, let's actually get to Yash to get details of this SEBI consultation paper, which has been floated to review delisting norms. SEBI, of course, has been trying to sort of look at other ways beyond just the reverse book building process if a company wants to delist. Yash has the details. Yash, tell us more.
Well, that's correct. So, SEBI chairperson in the previous board meeting also made an address to this thing, saying that they do not like Abhimanyus in the market. And this is exactly why this consultation paper has come out. The market regulator has proposed some very crucial changes when it comes to the current voluntary delisting regulations. SEBI has sought stakeholder comments on these proposed changes by September 4th. Now, the main focus of these changes has been on 4 segments of delisting process. First one on alternatives to the reverse book building mechanism under the delisting process. The next one is counter offer framework. Third one is determination of floor price. And the last one on review of reference date for determination of that floor price. Let's start with the first one. As far as those consultation paper is concerned, SEBI has proposed an alternate mechanism to the reverse book building process, which is the only delisting mechanism which exists today. This alternate mechanism would be delisting through a fixed price arrived as per the delisting regulation. What this does is that it reduces volatility, brings certainty on delisting prices, and also helps the acquirer arrange funds for delisting. The second one is on reduced threshold for counter offer when it comes to delisting after the first offer fails. If the acquirer cannot acquire 90% shares in the company, then the delisting fails. The proposal is to reduce the threshold from 90% for the counter offer. Now, the third change is on the eligibility criteria, coming out with a counter offer as far as delisting offer is concerned. In this case, the first one fails. SEBI says that the company can bring out a counter offer if the bids received in the first offer is higher of 2 things. First one, higher of the difference between the acquirer shareholding and 75%, and the second one is higher of the 50% of the public shareholding as far as the company is concerned. Currently, a counter offer on delisting can be brought irrespective of the kind of bids which have been received in the first delisting attempt. Now, the next one, SEBI is proposed to consider the date of a board meeting for approving the delisting as the reference date for determination of the floor price, instead of the current rule where the day of intimation to the stock exchanges on the board meeting is considered as far as the reference date for considering the floor price is concerned. SEBI has also proposed to bring out a separate delisting regulation for investment holding companies, under which the transfer of shares of listed companies held by this IHC will be done to public shareholders. Also, cash payments to public shareholders of IHC will be done against the investments in the unlisted companies. This is essentially to ensure that the delisting price for that investment holding company reflects its right intrinsic value.
Okay, all right. Yash, thanks very much for all the details. Quite exhaustive there. Thank you for the explanation. We'll watch out for more developments on that. Time for a quick break. We'll come back with more on the markets in just a bit.
Okay, welcome back. 28 points higher, but that is just, from yesterday's close, from the day's low, it's a massive recovery. We're just heading into the market, I think, close in another 5 minutes or so. Mayuresh Joshi is with us with, some thoughts and perspectives. Mayuresh, global price action may seem tricky. Yields globally may be headed higher. Whatever else may be happening, but the market here just doesn't want to stay down. And especially mid-caps, right? Small caps, actually. Not even mid-caps. Small caps. That's the part which is super, super strong. Your thoughts?
Afternoon, Prashant. Oh, absolutely. I think the market has been relentless as far as the broader markets are concerned. And to a large bit, they have not even corrected significantly in the last few days. In fact, any pullbacks that have probably happened have been bought very, very strongly as far as the mid-cap and the small-cap universe is concerned. Our only take here is that the distribution day count, as we see it at Markets with India, is on an elevated base at this juncture. And therefore, I think you have to be a little bit more specific when you're probably looking at broader stocks or the broader universe. But in a large element, I think a large part of the earnings has been in line with market estimates. And therefore, probably a large part of the market, Prashant, is holding out even as we speak.
Okay, just to get to a couple of, the stocks that we've been discussing. Mayuresh, your thoughts on the listing of the day? Any perspective over here as we are winding down? SBFC Finance is still holding on to this gain of 60%. What's the thought here and the related space when it comes to, small size banks?
So phenomenal listing. I think the base and the response was quite fabulous. I think the price is indicative of that. But generally, I think this entire space, the small finance banks, the microfinance units have done exceptionally well in the quarter gone by as well. I think a few numbers which probably stood out, both in terms of our EPS and RS ratings and rankings at MarketSmith, for Ujjivan Small Finance Bank, where asset quality pressures have clearly come off, the collection efficiencies have moved up significantly higher. And with the perspective that they've probably got in terms of capital adequacy, the return ratios look extremely strong. Take the case of Credit Access Grameen as well. Extremely strong positioning when it comes to the PPOP, more than 500 odd crores. Return on assets extremely strong. You're probably looking at asset quality pressures, both GNPAs and NPAs at 0.89, 0.29 respectively. And therefore, the expectation in terms of collection efficiency is improving with a larger scope in terms of even if NIMs moderate a tad bit of the balance sheet expansion probably staying in place is probably working for all these players to be. So yeah, I think the outlook probably remains a little bit robust as far as the management commentaries goes. And everybody's pointing out to the second half when festivities will come back with a roar, that balance sheet growth will be even stronger with lesser stress on the asset quality.
Mayuresh, quick question. A couple of the stocks that are buzzing, Aster DM, a while ago it had a lot of valuation comfort. Now we understand there is likely to be some kind of rejig out there with regard to their GCC operations. Any view on the stock, the hospital sector on the whole as well, if not Aster?
So Nigel, I think, again, this space expected to do well. The medical tourism part obviously is aiding most of these stocks, and the expectation is that this will only compound as we head into the next few quarters. The second element in terms of most of these hospital stocks have done reasonably better on most counts. So the average revenue per operating bed, taken in the instance of Apollo hospitals as well, the console numbers were a little bit on the weaker side. But the ARPOB probably showing an increasing trend. Same with the case with Max Healthcare, Narayan Rudralaya, so on and so forth. So I think the expectations in terms of the average revenue per bed should probably remain stable, increase going forward. The average length of stay and the embedded value that you probably get per operating bed is expected to improve going forward into medical tourism, expected to see a huge uptick in the second half. And most of these stocks which have their pharmacy business are showing some signs of stability. For some new age hospital stocks, where I think a lot of investments have gone into newer hospitals, the return on capital employed should improve going forward. So we have been positive on this space then.
All right, Mayuresh, we'll leave it there. Quick conversation today, but always appreciate your time here on CNBC-TV18. Thank you. Well, a 10-point change higher, but it's a giant recovery day today from the day's low. I think the Nifty Bank had a bit of a weaker recovery, so as to speak, and that ends about 1/3% lower, although that also sort of ticked off from the day's low by quite a bit. Small cap index 0.6%. That's the strongest part of the market, and that remains so. We've not even scratched the surface in terms of the number of stocks. I was just looking at the kind of stocks which have gone up. So many names go unmentioned because the list is so long, with the stocks from all kinds, smaller names doing very, very well. Sectors we identify, but I think markets are going down the curve to find smaller and smaller names and bidding them up. Guys.
Just to quickly talk about the large cap movers, we've ended on the green side, so I'll talk about the green stocks. Some of the IT names led by Infosys were up and about, almost 2% up on that stock. A couple of the names from the auto space, Maruti, for instance, up about 1%. You had some gains coming in on M&M as well after their launches in South Africa. Apollo Hospitals is a nifty winner, 2.5% up, followed by Ultratech Cement and NTPC. Actually, even Power Grid was up. Some of the frontline power names are not too bad. L&T, SBI, these were some of the heavyweights, along with HUL, that kept the flag flying high for the bulls. On the weak side, commodities, largely metals, Tata Steel and Hindalco, for instance, these are the weak links. And then, of course, banks, the Bank Nifty has ended with a cut of about 0.5%, can't take away from that. And Axis, IndusInd Bank are some examples of that weakness. But all in all, 12 points up, not bad. A good recovery from the opening lows. Well, with that, it's a wrap on this edition of Closing Bell. Thank you very much for being with us. But don't go anywhere, because our special offering, Mad About Markets, is coming up next. Today, we'll be talking about the comeback of the ethnic wear segment.